Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, April 15th. The markets swing up and down on tariff headlines. The US dollar remains broadly offered. Gold is in demand despite trading at record high levels, while crude oil is better bid despite waning growth expectations. So markets kicked off the new week on a positive note on relief regarding the consumer electronics tariffs that will not be exempt but will be part of a different tariff bucket, like 20% for all instead of 145% for those made in China. Then there was also some relief regarding auto and part makers as well on the tariff front. So the European stocks rallied 2.70% on this partial rollback of the tariffs. The US stocks, on the other hand, kicked off the week higher, but euphoria actually weakened into the session. And on fresh news that the US Commerce Department launched a probe into chips and pharmaceutical imports on national security reasons. So the S&P 500 closed the session some 0.80% higher only, while the technology-heavy Nasdaq 100 index that made such a beautiful start to the new week couldn't keep more than just 0.57 of this advance. On the individual front, Apple jumped nearly 7% at the open but ended yesterday's trading session 2.20% up only, while Nvidia was up by almost 3% at the open, but the stock closed yesterday's trading session 0.20% lower, and that despite announcing near $500 billion worth of infrastructure investment in the US with its buddies like TSM, for example. And the Taiwanese TSM, on the other hand, that's preparing to announce its first quarter results later this week, closed some 0.80% lower in New York yesterday. So this morning, the futures are flat. We don't even know if sentiment is good or bad. We see a mixed sentiment, really. I think that sentiment is pretty much dead. We're anesthetized on bipolar announcement from the US on tariffs that's taking a toll on companies and investors' ability to make decisions. Except for China, maybe, because China this week makes the decision of not reacting to the US anymore, which I think is quite a good option because I myself am dealing with a 4- and 6-year-old every day, and sometimes not reacting is the best reaction. So instead of responding to the US attacks, Chinese President Xi Jinping is making a tour across the Asian countries to convince the partners there that whatever they will negotiate with the US to avoid tariffs, it will not be stable enough than sealing a deal with China. Now, I'm not a fan of the Chinese regime, but I can't help myself but agree on that. Anyway, appetite for Chinese stocks remain limited still in all cases, with the CSI 300 index near flat this morning, and the Hang Seng index is giving back the early session gains. At this point, I actually believe that diversification of the portfolios is probably the best strategy to adopt with allocation to European and Chinese assets, if you like them, of course, as the trade chaos actually will offer an incentive for geographies other than the US to do better. And also keep in mind that volatility of the market helps the trading desk around the world post shiny revenues. Goldman Sachs in this context announced yesterday its best revenue for equities trading ever. Their desk made $4.2 billion last quarter as clients adjusted their portfolios in response to tariff-induced market swings. Now, uncertainties persist, obviously, and they will continue to persist. But the good news now is that the pressure on the US Treasuries front remains bearable. And that is actually one place that one should look carefully these days to judge how dangerous this volatility gets. Now, in this context, the US 2-year yield eased to 3.85% yesterday on expectation that the Fed would better intervene than not to keep the US economy afloat through the storm, while the 10-year yield eased to 4.35% level. We are substantially above the 3.8390% of a week ago, but the easing tensions in the Treasuries front hints that the sell-off across the stock markets could stabilize as well. All that, of course, under the assumption that the US President Donald Trump doesn't say anything extravagant in the coming hours or days, and obviously that no one can guarantee you. If you want protection from that, gold is there for you at around $30 per ounce level, which is a historical high level, obviously. So investors are asking, is it too high to buy right now? Well, the answer is yes, it's relatively high. If you look at the mint ratio, so the ratio between gold and silver, it spiked above 100 during last week's sell-off. So historically speaking, this ratio normally trends between 60 and 80 range and rises when growth expectations are cooling, because silver is more tied to industrial demand than gold, so it is riskier and more cyclical. Therefore, yes, gold is valued at around 100 times the same amount of silver, and that's quite high, but Goldman Sachs still expects the price of an ounce of gold to hit $4,000 per ounce level by the middle of next year. It is high, but what's high if China and other emerging market central banks were to replace their treasury holdings by gold? Is it still too high? We will see. And speaking of waning growth expectations, well, OPEC joined yesterday other agencies in announcing further cuts to its global demand forecast for this year and for next year on tariff uncertainty, obviously. So they lowered their projections by 100,000 barrels a day for this year and for next year. And now they predict that demand for oil will grow by around 1.3 million barrels per day, or about 1% over the next 2 years. So that's still very, very much higher than other agencies, mind you. The EIA, for example, dampened its own growth forecast by 30% to 900,000 barrels per day, while Goldman Sachs sees demand rising by only 500,000 barrels per day. Now, US crude is better a bit after last week's short crash to the $55 per barrel level, but risks obviously remain tilted toward the downside, with the next natural target for the bear standing near the $50 per barrel level. Now, in the FX markets, the more the US shakes the world with tariffs to get richer, the more the rest of the world dumps the US dollar. So in this context, the greenback remains under a decent selling pressure these days on waning growth expectations for the US economy. Now, note that growth expectations are also being pulled lower everywhere in the world, even in Germany, that will benefit from massive defense and infrastructure spending over the next few years, but the pace of deterioration of the US expectations are faster than elsewhere. As such, the US dollar index now consolidates below the 100 psychological level this morning. Note that we are now at the lowest levels in 3 years. The euro dollar in response remains bit above the 113 level. Cable extends gains above the 1.32 level, probably also fueled by better than expected growth data that was released in the UK last Friday. Then the dollar CAD sank below the 140 psychological mark, and also its 200-day moving average last week, despite the falling oil prices, while the dollar yen consolidates near the 142 to 143 level. The price rallies here could be interesting opportunities to strengthen short dollar yen positions on expectation that the Bank of Japan will remain supportive of the Japanese economy through the storm in this changing geopolitical spectrum, and also because Japanese yen used to be a safe haven currency and it is gaining back this status little by little. Now today, Canada and France will release their latest CPI updates, while German sentiment index and the Eurozone industrial production data are expected to come in soft enough guys, to cement the expectations that the European Central Bank will cut the interest rates by 25 basis points when the officials meet this week, and maybe also a few more times in the coming monetary policy meetings if inflation in the Eurozone remains under control, of course. So if that's the case, well, the softness of the economic data from the Eurozone could actually be good news for the euro and good news for the European stocks as well. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.